Welcome to Tax Sale Insiders, the latest from Tax Sale Resources, bringing you information about tax sales from experts in the industry. We interviewed Michael Bacalar, an administrator for Bacalar & Associates based out of Coral Springs, Florida. Bacalar & Associates is a real estate law firm that specializes in the Florida tax deed process. And in this interview, Michael shares all the ins and outs to the tax sale process in the Sunshine State. This is excellent information if you're looking to invest in Florida, so sit back and relax for another episode of Tax Sale Insiders, powered by Tax Sale Resources.
Hi, everyone. Welcome to another episode of Tax Sale Insiders. I have an excellent guest today. We're lucky enough to get Michael Bacalar from Bacalar & Associates. He's the administrator of it's a real estate law firm that actually helps investors, many investors in Florida on the tax lien and mostly on the tax deed side. But he's one of the few experts that really understand the whole process from start to finish. And is willing to talk to you all today. So, Michael, welcome. Thank you for joining us.
Hey, Brian. Thanks for having me.
So, I guess I gave maybe a poor attempt at trying to tell folks about your background. So, why don't you tell us yourself? What got you in the industry? Tell us a little bit about yourself.
Sure. Well, real quick disclosure: I'm not an attorney.
Yeah.
I work for the law office of Bacalar & Associates, but my wife, Susan Bacalar, is a real estate attorney. So don't anyone think that just because of the name that I'm giving legal advice, I don't do that. I got involved in real estate investing back in 2003 when I did my very first short sale before short sales were even in vogue. And we've been involved in short sales for residential property, for mobile homes, for commercial property. We've been investing on our own for flip and hold properties or flip and sell. Fix and hold properties and fix and sell properties, and we do a lot of work with investors who do the exact same thing. So we try to bring whatever interesting spin to properties that we can, and there's been a lot of interest in people investing in Florida in tax deeds, and we have some very, very well-to-do clients that spend a lot of money on research and purchasing tax deed property. So I appreciate being called an expert. I just happen to have a lot of experience.
Sometimes experts or experience goes well beyond just being educated, right?
Right.
Real world experience, which is I know folks that are watching, you'll see as we get into this. But Michael has some really great real world stories of things that you find in the tax deed space in Florida or just in the tax lien industry in general that you don't typically in regular real estate or really any other space. So anyway, I don't want to steal your thunder, Michael.
No worries.
I'm going to start with just the basics of Florida for anybody that's on that doesn't already understand Florida. So would you consider Florida a lien state, tax lien state, a tax deed state, a combination, a hybrid?
Well, it's both. In Florida, you can be an investor and purchase tax liens, which are tax certificates, or you can be an investor that purchases tax deeds. The difference is when you have a tax lien or a tax certificate, you're basically giving a loan on the property and you're getting interest on the money that you advanced. So when someone doesn't pay their property taxes and the county relies upon the payment of that money to pay bills, the county then sells a certificate. So if you pay $5,000 per certificate, you're paying someone else's indebtedness, and for that privilege, you get paid interest. If you buy a tax deed, you actually get title to the property. So a certificate gives you an interest by virtue of money you paid advancing for someone else. And the deed actually gives you ownership. You get a deed, a tax deed, you are the owner. So Florida does both tax liens and tax deeds.
Got it. And thanks for the explanation between the two. I know there's lots of interpretations on what the heck a tax lien means versus tax deed. When do you have rights to the property or not? And you explained some of that. We don't have to get into minute details. Mm-hmm. But the whole point of the story is Florida has both, right? There's states that have one or the other. Florida was one of the few that have both. You can go buy a lien and then you can go buy a deed separately, separate sales. You don't have to foreclose on the lien in order to get the deed. It's two different sales.
Right.
Okay. Well, let's start with the lien side of it. We'll get into the deed side in a little bit, but on the lien side of it, when do the auctions occur? Are they, all the time throughout the year? Are they specific time of year?
Well, they start in May. Taxes are due and payable through April, and then most counties start the tax lien sale process in May and June.
Mhm.
Now, every county has taxes that are due and payable by an owner, and if they're not paid, every county will sell certificates, and they usually all have them at the same time. We were talking earlier that Florida is consistently inconsistent. One of the things that is consistent is every county sells tax certificates as soon as they're first able to do that.
Now, is it, are they sold online? Are they live? Is it kind of a mixture?
So Florida has, I think, 67 counties, and most counties are live. Some counties are in person, and where we see more benefit to the in-person bidding is on the tax deed side. You have many fewer people going physically to the courthouse to bid in person than you do online. Think about it. If you're an investor in Israel or in Germany or in North Carolina wanting to bid in Florida, you're just doing it from the comfort of your desk.
Mhm.
But for counties that are not held live, being there in person, there's many, many fewer people that show up to do those. So you'll see more of the same faces getting more properties because there's so much less competition.
And we see that across the board, not just Florida, but everywhere where it's still a live sale, there's less competition, typically a little better rates, a little better deals. I mean, I can't say that's fact everywhere, but in general, that holds true just about everywhere in the country. Now, as far as the bidding process for liens, we'll get to deeds again here in a little bit, but on the lien side, it's a bid down process, correct?
Right.
And bid down start at 18%, and then either whether it's live or online, you put in whatever your bid is in 1/4% intervals all the way down to essentially down to zero, right? You could.
Right. I've not seen any that are zero. The lowest I've seen is 1/4%.
Okay.
But Brian's right. Florida starts at 18%, and as you have competition, people are willing to make less interest on their money, and they'll bid down to whoever's going to take the lowest interest rate and still pay the unpaid funds.
Got it. Now, one of the things I do want to make sure we point out is there's actually a book about it called The Fast Five out there for those folks looking for it. It's a model where, Florida's unique that it has this automatic penalty, right? A 5% penalty. So explain to us how that works in an interest calculation.
So if you buy a tax certificate and you bid down below 5%, the minimum that the county is going to impute when you get paid off is actually 5%. So if you buy a certificate and you hold it for a year, and then the owner of the property ends up redeeming the certificate, you're going to get your principal back, which was the amount you paid for the unpaid taxes, plus 5%. If you bought the certificate at a rate that's higher than 5%, then you'll get the higher rate.
Got it. So if you bid it under 5%, your whole goal is that hopefully it redeems fairly quickly, right? You're in that 5%, whether it's the next day or the next month. But if it happens to go out the full 2 years, then obviously that rate.
Well, it's 5% per annum, which is broken down to a certain amount per month. It's actually broken down per diem. But the beauty in investing in tax deeds, which is a foray in tax certificates and deeds, is that most people investing in tax certificates are hoping to eventually get the property, right? Mm-hmm. So if someone has unpaid taxes for 10 grand, you're going to tie up $10,000. It's going to sit there tied up for, up to 2 years. So your goal is, I don't want, the 3 or 4 or 5% I'm going to get on my money, which is still better than in the market or in a bank. Most people want the property, but the chance of actually getting the property are very, very slim because there's so much competition in Florida to buy the properties that the amounts are usually overbid. Mm-hmm. So the investor gets paid off, and some third party that comes in to bid ends up getting the winning bid and gets the property. So then the rest of the money just sits in the court registry for the former owner and the former mortgage holder to fight over who gets what.
So if you're after properties, definitely don't plan on attending the lien sale or buying the liens. You might as well just attend the deed sales and buy the property directly, correct?
Right.
Okay, so one of the things I've heard about Michael, in Florida is on the lien side of it is this single simultaneous bidder versus multiple bidder counties, right? It depends on which county. Can you help? Can you help? I guess the viewers understand a little better why there's so much buzz around that.
I don't know that there's a lot of buzz. It's pretty straightforward. Most of the counties in Florida do their auctions through a company called realauction.com. So you can register for a free account, a free bidder account at realauction.com, and it'll show you which counties they do, and other counties that aren't listed on their site use other vendors like Grant Street. But all the accounts are free. So you register for a bidder account, and you can have a primary account. If you have multiple companies, you can register sub-accounts so that you have one main account, but you can bid under other accounts. Now, the benefit to doing that is, and actually I don't know what the benefit is to doing that, because you can bid on multiple properties under one name. The only reason someone want to bid with multiple names is if they don't want a specific property in a specific company or individual's name. So we have a client out of Chicago, and we do their bidding for them in all the states that have bidding electronically. And we register whatever LLC they want in Florida, and then we bid under that LLC's name. And when you go online to do your bidding, you have to designate, should I win this property, this is the name I want title vested in. So if you want to have the opportunity to have title vested in more than one company, then you take that other company and you make it a sub-account. But you have to fund them separately. So there's a lot more accounting and math to it. So when you go to bid on a property in Florida, you got to preload your account with a certain percentage of what you expect to bid. So in Florida, you get a 20-time multiplier. If you plan on spending up to $100,000 on a property, you put $5,000 in, and if you win, Florida says, okay, you now have X number of day or hours to pay the balance in order to get the property deeded to you. It's always next day. We always advocate pay as soon as you win, and we'll get into that later as to why. But you can have multiple accounts, but you have to fund each account separately. You can't commingle funds from one to another.
Got it. So the multi versus single really doesn't make a difference when you're buying the deeds, but on the lien side, I guess where it comes into play is there are some counties that it's really split down the middle. I guess half the counties allow multiple simultaneous bidders, and half the counties allow only a single. And really, why that matters on the lien side is everyone will bid the good stuff down to 0.25%. And at that point, the computer basically takes over and says, I'm going to make a random selection. And the counties where it's a single bidder only allowed, everyone's on the is on level playing ground, right? Everyone has one bidder ID. So a giant fund, if there's 10 different bidders, you get 10% chance. The multiple bidder counties, at least from the lien side, I know when it gets down to that random selection, a lot of funds have went out there and they either leased or have purchased thousands and thousands of EINs, allowing them to basically up the odds in their favor, right? So if there's 10 bidders, but you have one of those, and this is a multi-bidder county, keep in mind, and if one of those funds has 10,000 EINs and everyone else has one, obviously the chance of them getting pulled at random is a lot higher than everyone else.
Right.
So that matters in the bid down lien scenario, but obviously in the deed scenario, the only time you really want to do that is to kind of control what deeds go in which name, it sounds like. Okay.
Right. And in Florida, we have proxy bidding. I'm sure the other states have it also, but with proxy bidding, you'll have each account that you want to bid under, and then you can identify the properties you want to bid on, and then you set your amounts, and it's kind of like set it and forget it. Mm-hmm. You set your minimum bid, it goes up $100 increments, and then you set a maximum, and that way you're not having to watch every property. You'll get emails from the county, whether you won or not, as they go down the line. So you can have, it doesn't benefit you to have more than one account, because you still have to fund those accounts and place your bids, right?
Right. There's more and more capital you got to put out there, you got more headache to deal with on the deed side, and really no advantage to it really at all, because the high bid wins, right? Whatever the high bid is. Okay, so I guess back to the basics on the lien side. So I attend the sale, an online sale. I win the bid at whatever percentage. Let's say it's 0.25%. I now own that certificate. There's a redemption period. Is there anything else required by the investor during that redemption period, or is it a set it and forget it situation?
A set it and forget it situation, yeah.
Okay. For my understanding is at least 22 months or 24 months
For the redemption?
for the redemption period. Yeah.
22.
22.
Yeah.
And then do liens, I guess, is there a maximum? If I don't want to file for a TDA, can I let it go forever?
Well, they'll expire in 7 years.
Okay.
So if you don't take any action within 7 years, you're going to lose your lien and you're also going to lose your investment.
So you have to wait at least 22 months, no later than 7 years, and somewhere in there you have to do something. So I know this is kind of where your forte on the TDA side. So what do you have to do exactly to take that next step sometime in that 22 to 7 year mark?
So a certificate holder is the only one that can force a sale. So the certificate holder has to petition the court, the county court that held that filed the case to prosecute the unpaid taxes. You file an application with them. There's a filing fee, and it's different for the counties, and you have to have that served. But the county goes through a whole process on identifying properties to be sold based upon an investor asking for that to happen. As long as the investor has the tax certificate, they're required to bring current any taxes that came due subsequent to them receiving the certificate. So in Florida, you can't push a sale forward for 2 years. And if I'm an investor who bought a certificate in 2018 and Brian bought one in 19, and now we're in 21, but if I'm gonna ask for the county to sell the property, I have to pay everything due, including paying off Brian, who would otherwise be foreclosed out in the sale. So the investor requesting the county to sell the property has to pay off any other investors downstream from them who bought certificates after them. And certificates can keep getting sold each year. Just because 2 years happen doesn't mean that at 2 years, the first certificate holder is going to actually request the sale to take place. A lot of people don't know they can do that. So there might be 2 or 3 or 4 years of certificates sold that I, the one pushing the property to sale, have to pay. So everyone gets redeemed. They get their principal, they get interest. You also have to pay the court costs, the filing fees, any publication charges, anything the court tells you was due, you have to pay them before they'll even start the process for advertising the property for sale. That make sense?
Mm-hmm. Yeah, I think you brought up one point, and then we can kind of move on to the next question. But your point about every year a new lien can get sold, and one thing that happens in other states that doesn't, you can correct me if I'm wrong here, Michael, but in other states there's subsequent taxes, right? In several other states, the current lien holder gets first right to buy those and then earn interest at whatever the maximum statute interest may be. One of the major states comes to mind is New Jersey, right? Mm-hmm. Everyone bids down to zero. A lot of, at least currently, people then bid a premium. They really don't make anything on that first lien they buy. They're banking on the fact in 6 months I have first right at that subsequent lien at, I think, 18%. Don't quote me on that. Well, I guess I'm recorded. I think it's 18%. So it starts to make sense over a period of time. Whereas in Florida, you don't have that first right? There's no, you have to bid on each lien individually. So you can't build a model around buying a lien, assuming that you're going to earn 0.25% or that minimum 5%. And then next year you're going to earn get first right and earn 18% on that next lien. That does not happen in Florida, correct?
Correct. Okay. And there are investors that we've dealt with that buy certificates in other states, and they have that mindset. So they'll call us and say, listen, I bought a certificate and now the taxes are still unpaid for this year. I want to get in line and buy the certificate again. I'm like, well, why would you do that? You're already in first position. Why put out even more money knowing that when you want to push your first certificate to sale, you're going to pay yourself off. You've already paid the money. So you don't need to do that. Yeah. I'd rather see an investor pay someone else off in prosecuting their tax certificate to a tax deed than buying 2 certificates in 2 consecutive years on the same property. You're just putting money out there that you could otherwise use for other properties. Right.
All right. Okay. So I'm going to pull us out of a rabbit hole a little bit and back to, okay, so I had to pay all these other liens off to file for this TDA, this tax deed application, right? I'm the lien holder. And then there's a period of time you have to wait, right? How long does that take until the actual sale takes place? Is that a next week? Is that a 2 month, 3 months?
No, the county, each county goes through a process to sell the indebtedness at public auction. So the county attorney does all the things they need to do to clear, quote unquote, clear title and name every interested party in order to have the sale go through. Tax deed purchasing is always buyer beware. Never assume that you're getting it free and clear. Never assume that the county is named everyone they're supposed to, and never assume there aren't going to be problems. Every file has its own nuances, but you got to do your homework.
Got it. So it's a several month process where the county goes through this noticing. Basically, that is the foreclosure process, right? The county is doing that for the foreclosure process of notifying the other interested parties, saying you're going to lose this property ultimately unless you pay X dollars. And if you don't by this date, then we're going to sell the property.
Right. The notice requirements are the same. You know, every county has to publish the notice of sale once a week for 4 weeks in a local business paper or a local newspaper if there isn't a business paper. So if you're in Southeast Florida, Dade County, you know, Miami, Fort Lauderdale, Palm Beach, we all publish in the Daily Business Review. It's a well-read business journal newspaper, and it's online and in print. But other places that don't have the luxury of having a business paper, the county will publish it in a local paper. The whole point is getting notice out there to hopefully notify that individual that is the owner or that corporation that owns it that, hey, there's a problem with this property and there's money that's due. And if you don't act quickly, you could lose your interest and lose the property.
Got it.
Yes, but it's once a week for 4 weeks.
That they advertise it?
Yeah, the publication.
So a minimum of 4 weeks. And then how long does that process typically take from the TDA application to the sale taking place?
Well, it could take months.
Okay.
We've seen different county attorneys in different municipalities or different jurisdictions take much longer to go from one step to the next. Sometimes they serve, they use a process server to serve the paperwork. For those that they can't serve, they have to publish the notices of constructive service. And we've seen months in between when they finish one step to when they start the next step. It's supposed to follow a set guideline, but like I said, Florida is consistently inconsistent in how they do things.
So it's anywhere from that minimum of 4 weeks through 6
3 or
months.
4 months.
It just depends on which county.
Right.
Now, does I'm assuming the investor that bought the certificate is still earning interest in that 3 to 6 month period, right? It's not. Does that change at all, or is it still whatever you bid?
It's whatever you bid.
Okay.
Yeah.
All right. Okay, so I guess moving forward a step. Now I'm going to shift gears a little bit and get more into the real estate side. So I'm an investor and I'm going to attend this tax deed auction, right? The lien, I don't care about the liens. I want to buy the property. So these tax deed auctions are occurring. How do they, like, when do they occur? I mean, are they similar like the liens? Are they one time a year? Are they all the time?
Some states have, once or twice a year auctions where they sell thousands and thousands of liens at the same time. Florida, every county sells their tax deeds once a month. They're advertised on a monthly calendar. So going back to, if you go to a real auction and you establish a bidder account and you do it for each county, you get a master account and then you can bid in each county. When you're on their website, you click on the auction calendar and you'll see just how many properties are being advertised for sale. And when you click on the auction calendar, it'll show you ones that are advertised for sale versus ones that have been redeemed or there's been a bankruptcy where it's been canceled. But every county sells them every month unless they don't have any to sell. But typically, every county has sales every month. It could be one property, it could be 100 properties. You don't know, and every month is different depending upon the population of the county. There's more or less there's more or less deeds to go to auction.
Got it. So you can, from a real estate investor perspective, the nice thing is they're happening all the time at somewhere across the state.
Right.
You don't have to plan and do all your investing in a month like the lien side. You can kind of spread it out, or if you win a property and end up selling it, you can go buy another one. You have an ongoing conveyor belt of inventory.
Exactly. Yeah.
Got it. Now, how does that? I guess how's the opening bid set? Is it a I'm assuming it's at least the taxes plus interest, or how does that work?
Sure. So here, let me just pull up. I'll tell you exactly. So the amount of the opening bid is based upon the unpaid taxes and costs that were incurred by the certificate holder. So I buy a certificate in 2017. Whatever costs I incurred in addition to the unpaid tax, the county charges a recording fee, and they charge postage, and they charge a processing fee. That total amount is amount A. So that's the first thing you add. Next, it is interest from the month of your application through the month of the sale. And that's the county calculates that for you. You don't have to do it on your own. They'll tell you this is the amount. Then it's also the amount that's required to redeem any certificates that were issued after yours. So if you remember back, I said, if I have a certificate from 17 and I'm not pushing it forward to sale, and Brian had one from 18, I have to include any indebtedness that you're owed, anything that you paid. And if there's a certificate holder after you, I got to pay them all off. So the county says, this is the amount you have to pay. And once you pay that, that's when they continue moving their file forward. One of the nuances is if the property is a homestead residential property, the county is going to add 50% of the tax assessed value to that base number. So if the house is, an ARV for the house is 200 and it's tax assessed at 150, they're going to add $75,000 to the other numbers, meaning the amounts of the certificates, interest, court costs, filing fees, and that's your opening bid. So that's where the bids comes from. For properties that don't have a gargantuan number, they're typically not homestead properties because those always have 50% of the assessed value added to all the rest of the numbers.
Got it. So the homestead properties are special, I guess, in other words.
They're special only because they cost you more to start off with.
Got it. Now, is that, are there properties that don't sell because they are half, or is the market competitive enough in Florida that even though it starts higher, nicer properties are going to sell for higher anyway, so it doesn't really make a difference?
Well, look, the bottom line is a property is always worth what it's worth, right? It's worth what someone's going to pay for it. If you go by the tax assessed value, which we don't ever suggest doing, we always suggest do your homework and get your fair market value. If the tax assessed value is 200 and the FMV is 250, you know that if you're going to set a threshold of this is the most I'm going to spend, that what that percentage or that number is going to be, you don't bid more than that. The reason I'm saying that is we see lots of people that get bid crazy. It's kind of like the days of bidding on eBay. I can't miss this, I got to win. And they bid actual property value, not taking into account holding costs, insurance, the fact that they're paying property taxes once they win, the cost for legal fees if they have to do quiet title. So we have clients that have come to us, hey, I'm over invested. How did that happen? Well, you bid too much. So the bottom line is know your numbers and do your homework.
We'll mention that a few times throughout this.
Yeah.
That's the bottom line all the time. It seems like just knowing what you're buying, right?
Right.
Okay, so I'm going to take a little step back, and we talked about the sales that occur, throughout the year, at least monthly in most counties. I guess in some cases weekly in the larger counties. How do I participate in those? Those are also online, right? I have to register. Are there still some that are live auctions in Florida?
That's the second part of the question again. You broke up.
There's still some auctions that are live versus online.
Yeah, like I said, there's 67. I think there's 67 counties in Florida. Most of them are live. I mean, most of them are online. There are a handful of counties that do live bidding, and those are the ones where, at least in my opinion, there's more opportunity because the world of investors is much smaller. Because you have to physically go there or send a proxy to bid for you, but there's many more people bidding online than there are in person.
Got it. So it's because they have them on, I'm assuming, there's some states that have interesting statutes where you have to be a resident, or your proxy has to be a resident of Florida, or of that state. Does Florida have anything similar to that?
No.
You have to even have if you're an LLC, do you have to be registered as a foreign entity in Florida or anything like that?
Well, to do business in Florida as an LLC, if you're a corporation in Delaware or New Jersey or Iowa, you register in Florida as a foreign corporation doing business in Florida. And when you register your bidder account, you'll give them your Florida Division of Corporations printout that shows that you are a foreign corporation registered doing business in Florida. And the key thing is that you have a Florida registered agent. So anyone can bid from anywhere in the world, from any corporation anywhere, as long as they're able to do business in Florida. And actually, they don't even check. If you just register your corporation and don't put what state you're in, they're going to issue the tax deed in the name of that corporation. They don't ask really, well, where is your corporation domiciled? They don't. I've never seen anyone that's come to us with a problem saying, I didn't realize I had to be in Florida. You just need a Florida agent.
So that if you're not registered in Florida, you should be. Definitely not recommending that you don't, but that's never come up in a I guess a contested, a former owner maybe contesting a sale where they say, no, this person bought it, but they're not registered in Florida. That's never come up in your experience.
I haven't seen that.
Okay.
No. Have you?
There's, I believe it was Missouri. The gentleman was mentioned that actually will come up in a foreclosure, post foreclosure proceedings. Not often, but they'll definitely check for that.
Right.
So a little more stickler about it in Missouri than some states.
Well, I'm not aware of it, but just because I haven't seen it doesn't mean it hasn't happened. But we haven't seen it in our practice.
Always do the right thing, right? Register as a foreign entity.
Exactly.
Create less problems for you down the road at some point, anyway.
Right.
Okay, so as far as registering for the sale, I think you mentioned you have to put in, or you get up to, you said 25 times whatever you deposit.
So Florida gives you a 20-time multiplier.
Okay.
So you put in 5%, and they give you 20 times that towards your maximum allowable purchase. So you have to know your numbers to know how much you're going to fund your account with. And if you're bidding on multiple properties, you want to make sure that you have enough of a deposit, assuming you're going to win each property, to cover you for the deposits. Because if you win all the properties and you haven't made sufficient bid deposits and you're short, you're going to lose that property.
Is there a minimum, like, okay, so 20 multiple, but you have to deposit at least $1,000 or 100? You can deposit.
No, it's the 5% is the generally accepted minimum. I've seen some counties where they'll accept $200.
Okay.
And then you have to fund the difference and then pay the balance once you win.
Got it.
More often than not, we have all of our clients usually deposit funds in our trust account, and we make the deposits for them. Some clients want to do their own wire transfers or their own ACHs or send their own cashier's checks or go in person. Others just have us do it. And earlier I said that every county isn't the same. So if you want to do your bids, some counties, especially if you do an ACH deposit, an ACH transfer, they require 5 business days for that money to clear. Other counties will accept a wire transfer, the day before. As long as your money is there but prior to the bidding at 10 a.m., they consider your money received. But if you think about how many more dollars you have to put in by doing ACH, knowing that a lot of properties fall off of the sales because they get redeemed, you'll save yourself a lot of money out of your pocket. Not that you lose the money, but you'll save having to make much larger deposits if you do them by wire or a cashier's check the day or two before the sale, as opposed to an ACH 7 days before the sale.
Got it. So every state, every county is a little different.
Right.
So, reach out to the county, do your homework, make sure you know what you have to deposit, when you have to deposit it, and make sure you have your ducks in a row. Otherwise, you don't want to do all the work to research the properties and then end up not actually being able to attend, right?
Right. And one way to make that process easier, is for the properties that have the sales done by Real Auction. Real Auction has a customer service phone number. If you call that number, say, I'm registered a bidder in Lee County, when are my deposits due and how can I pay them? They'll give you all the information right there, as opposed to having to go from county to county's website to figure out what's due and when.
Excellent. Okay.
Yeah, they made my life easier in that respect, because I was calling each county before I realized I can just call this one number.
Save you a ton of time.
Yeah.
Okay, so I attend the auction, I bid on that property. I'm assuming it's a standard, I guess you said like a proxy bid, but bid up scenario, right? $100 increments, whether it's online or live, it's really run basically the same. High bidder wins, right? And then you have a period of time to pay the difference between your deposit and what your winning bid was.
Right.
If you actually bid or won multiple properties, you got to pay the total difference on them all.
Right.
At that point, is there any additional waiting period before you get a deed? Is there any additional redemption period where the previous owner can redeem? Does anything like that exist in Florida?
So the redemption period is the amount of time between when you make your winning bid and when you pay the balance. So if you have and all the counties sell the properties one at a time. So that goes down the list. So when you're looking online, it'll say currently at auction, waiting for sale, the next one down. So they do them one at a time. They're not like hundreds sold at the same time, because otherwise there's no way to really to watch them. That's part of the beauty of proxy bidding, is that you can set it and forget it. You set your maximum, and the bid increments, if you're doing proxy bidding, is $100 per increment. But if you're a live bidder, like if I'm watching a property, I want that property on the water in Palm Beach, I won't use proxy bidding. I might jump my bids by $1,000 or $2,000 or $3,000 at a time. And that will take care of people who set their proxy bids lower than my maximum. But I've also seen most oftentimes that there's people setting their increments higher, and we've lost multiple properties by $100. Just because our client said the most I'm spending is X, and someone else spent X plus $100. So you do your deposit, you place your bid, you win the bid, and then you have 24 hours, most instances, to pay the balance. Now, some counties say you must pay within 24 hours of the close of that particular sale. So if the property sale concluded at 10:13 a.m., you have until 10:13 a.m. tomorrow, next business day, to pay the balance. And more often than not, the counties accept payment of the balance by wire transfer. So my point in saying that is, to Brian's question, how much time does someone have to redeem the property? The redemption period is technically the amount of time from when you paid your bid and won the property to when the county receives your money. So we've had instances where clients have bought great properties, and then the owner who just is losing title goes to the courthouse and they pay everything due, and then that sale gets canceled. The bidder gets the money deposited back in their account. It didn't cost them anything. They're not out any money. But had that former owner not known to go to the court and pay, and you wait a day to get your money in, it's going to take an extra day to get your deed. So as soon as you get the email from the county, and they always send you an email, congratulations, you won, 123 Easy Street. Don't hesitate. Go online, schedule your wire, go to the bank, get your cashier's check, send it to the courthouse. Don't just wait and let them get it the next day, because people do lose properties because they waited too long to pay the balance. Not that they weren't trying to pay the balance when it was due, but someone got to the former owner and said, hey, you're gonna lose your property. You better go pay this now. Case in point is, there's an investor that we used to work with who used to write to people and say, hey, your property is going to sale on this day. And he would watch the sales and realize that potential client 1, 2, and 3 each just lost the property, and he'll call them and say, listen, you just lost your property at sale. I will go and advance the money to pay this for you, sign my real estate contract. I'll pay you more to buy your property than you'll get back if you petition for overages in the court registry, if there's an overbid situation. That make sense?
Yeah, interesting model. You gotta stay on top of it. They don't give you a whole lot of time to make that happen.
Right, but this person has already been in negotiation with the owner, who has just been obstinate. I don't want to sell. Well, now they're in a position of, you just are in the process of losing your property. Sign my contract, and I'll advance that money to keep the property from getting lost, and you'll still end up pocketing more money by me buying your property than you would if you petition the court for anything left over as an overage in the registry. And an overage is, if the opening bid is 10 grand and someone bids 80, there's $70,000 in the court registry for the former owner and the former mortgage holder and anyone with interest to fight over. But that doesn't matter to the investor. You got the property for your 10 grand.
Right.
I mean, for your $80,000.
Got it. So they're overages. They're basically what's due to the prior owner or anybody that has interest in the property, like you said.
Right. Anything that's paid over and above the minimum amount to transact the deed, goes to the court registry as an overage that anyone with an interest can petition for, and it's up to the court to determine the order of priority and who gets paid what. Got it. But keep in mind that when the properties go to tax deed auction, the mortgage holder's already been put on notice if there's a mortgage. So mortgage holders, if there's a mortgage on the property and it doesn't get paid by the bank, you got to ask yourself a question. Why didn't the bank pay the indebtedness to keep from losing the interest in the property? So that's one of the things we tell the investors who are doing the research. If there's a mortgage there, look at the mortgage. Is it in default? Are the notices going to the right address? Like, there's ways to determine good versus bad properties, but typically those that have mortgages, if it's good enough for a bank to lend on, it's typically good for someone to buy. You know,
Yeah.
banks aren't going to lend on bad properties or properties in the hood or properties that are, you know, in terrible condition, because they do inspect properties before they give their money. So if you do see a property when you're looking at the research done by the county and there was a mortgage, that's a good property to spend more time considering, because the bank, it was good enough for a bank to loan on.
At least at the time they loaned on.
Yeah, right.
Always make sure to see what the property looks like today.
Exactly.
All right. So, okay. So continuing down the kind of the timeline of, I attended the auction, I bid, I paid my difference. I technically own that property now, right? Do I have to do anything in addition to get that deed, or is it the county will just send me a deed in the mail?
You don't need to do anything to get the deed.
Okay.
Once you pay your bid, you win the property, you tender the exact amount you're asked to send, and you send it by the time it's due. Within a day or two, the county records a tax deed, and then they send it to you in an email.
Okay. And now you're the lucky owner of that property.
Right.
So let's talk about a little bit of what happens. Well, before we get to that, I'm sure there's situations where properties don't sell at auction on occasion. Right. What happens to those properties?
Those go to the county. They become listed on lands available by the county. It's a separate list of properties to bid on.
Mm-hmm.
Those get republished and re-advertised. But for properties that don't sell at auction, there's generally reasons why they don't sell. There are things that most people don't want to buy.
Right.
We've seen properties come up for sale time and time and time again, year after year, and they never get purchased. They always stay a county land. And when you start doing your due diligence and say, hey, there may be some opportunity here, you have to ask yourself, why did it not sell? Why did it become a county land? And here's a good example. We have a client, or a guy that does billboards on highways, right? So he looks for properties that had rights of ways and easements on the Florida Turnpike, on different major thoroughfares, and says, no one's going to want to buy this. Because when you buy it, you got to maintain it, right? You got to cut the grass, you got to maintain the lighting, you got to maintain the drainage. Mm-hmm. And those were county responsibilities that then fall to the property owner. So he'll buy a folio that's gone to sale that might be an exit off the highway, and he knows already in advance where he can and can't place billboards. And he uses like 3-sided billboards, so you see it from the north and from the south and from getting on the exit. So he's like, I'll buy those properties because my exit strategy is billboards or signs. But for most people, they don't want to do that. So I don't really ever advocate or even offer to do the research for people to buy properties that have become county lands, because there's something wrong with them.
Mm. There's talk about finding a needle in the haystack, because all of that stuff is typically I guess having some insight into markets across the country. You know, Florida is one of the most efficient, I'll call it, meaning if there is something of value, it will likely get sold, or if it's something of value to most people, it will likely get sold for something. So the stuff that ends up in this list of lands available is stuff that most people don't find valuable, right? So you either have to have a very, very specialized model like the billboard you just talked about, or something similar or crazy like that. Or like you said, maybe just avoid those altogether.
Right.
Now, if it goes on the list of lands available, does it stay in that cycle forever? Like eventually, it sheets to the county, is that right?
It sheets to the state at a certain point in time, although I don't know that time period because we're not involved at all with bidding on county-owned lands.
Okay. So it doesn't sit on that list of lands available forever. It does eventually go to somewhere. You know,
in the cobwebs of my mind, I think it's 7 years.
Okay.
At which point the county stops advertising it for sales, because that's when the first certificate that would have been redeemed expires. So again, we don't get involved in county-owned lands, but something makes me think that there is a 7-year window there as well.
Got it. Okay. All right. Now back to, I bought this property. I received the deed. I'm the proud owner. From a from a title perspective, and this is a part of buying tax deeds, a lot of people just getting into the industry don't really realize is from a title perspective, Florida deeds aren't, I'll say, clean, right? They're dirty. They got some baggage.
There's a cloud on title.
Quiet title, yep.
Yeah.
So what does that, I guess, are there different options in Florida, or what do you have to do to get insurable title?
So when someone buys a property, if we're doing a regular transaction, like Brian selling me his house, I, as the buyer, want to know that I have clear and marketable title. So you get title insurance, right? Especially if you have a mortgage, you're going to get title insurance and a mortgagee policy. When you buy a property, a tax deed, you can assume that the county's done all the things they need to do to extinguish the rights for that former owner, which includes the name of the mortgage holder. In Florida, we have this weird statute that says if you have a property that's on the water, like on a lake or a canal or on intercoastal on the ocean, that the county also needs to name and serve the contiguous property owners. So if there's a house to my left or to my right that touches my property and my property touches water, the county has to name those people and just say, listen, this is the process going on. And we've seen numerous instances where someone was asleep at the wheel and they didn't do that. That's a problem for the county, because if they didn't do proper notice, that sale could potentially be unwound. So we have found ways to get people their property back, but we're not really talking about that. We're talking about what do you do when you get it? So when you get it and you want to have clear marketable title, you have to do a quiet title action. There's insurance companies that will tell you that they'll review your property for between $750 and $900 and give you a certificate. But more often than not, once they realize it's been purchased at tax deed sale, they always tell you, get an attorney and do a quiet title action. So that is the way to get clear and marketable title with no questions asked. Once you have that judgment quieting title and you have that entered in the court record and also in the public record, that's your real estate get out of jail free card as the date that thing was recorded. There's no impediments against the property. Not to say if you go to sell it later that something hasn't come up in the interim, but those are really easy to deal with. It's usually an unpaid water bill or a code violation, but other than that, a quiet title action is the gold standard in getting clear marketable title.
Got it. So it's if there were issues in what the county did in their process, the quiet title will resolve those.
Right. Yeah. So here's a good example. We had a client that bought a property in Lee County. It's on the west coast of Florida, and every property has a legal description. It's meets and bounds, or it's lot number, block number. And in this instance, the county attorney included in the legal description a piece of land 1 foot wide by 100 feet long, so 100 square feet, of the neighbor's property. So when we review the title, we say, wait a minute, there's something wrong here. There's an overlap. And it turned out when we looked at the plat map and actually got into looking at the actual legal descriptions, we realized that the county made a mistake in including 100 square feet of someone else's land in this land that our client just bought. We had to go to court and get that amended and fixed, and it wasn't a big deal, but it went from the county tax assessor and the property appraiser all the way through the county attorney, and no one picked up on this until it came time to issue a title policy on it, which is where we came in.
Got it. So that's one of the services you guys provide, is the quiet title aspect.
Yeah.
Got it. Okay, so the quiet title will help the insurable title aspect, but are there any other liens, I'll say municipal fines, anything like that may survive the tax deed auction that
Sure.
the luckily,
Right. So in Florida, homeowners associations and condominium associations, their liens get extinguished. Mortgage holders' liens get extinguished if they're named and served. Anyone's interest can be extinguished if they're named and served and don't file a viable defense. But covenants that run with a land, city code violations, and municipal liens, and of course, Uncle Sam, IRS, they always get paid, and those interests generally don't get extinguished. So it's mainly HOAs, condos, mechanics liens, things that don't travel with the land all get extinguished. But just because you buy a property at tax deed, unless you do a quiet title to further extinguish any other interest, those things will survive, although they may not all be due and owing by the person who then owns the property. So if there was an IRS lien against John Q. Public, who lost title of the property, that lien is against him, not the property. So certain things don't really make a difference but other things do, like code violations, city and municipal liens, and covenants that run with the land.
Okay, so those stick with the property. Most
Yeah.
of you did mention something interesting, so I want to ask a little further on that. You said if they are named in the notification, right, that the county does. So if a county misses a mortgage holder on a property and they don't name them, that means that that mortgage wasn't wiped out?
Correct.
Does that happen often?
It happens more often in residential single-family homes than it does for condominiums.
Mm-hmm.
When someone's looking at a title search to prepare a lawsuit, whether it's a foreclosure or a quiet title action, if you do a search back to the date when the property was platted, it could be a long search and someone has to examine it. But somewhere in there, you'll see the recorded declaration of covenants and restrictions for ABC Homeowners Association. Subsequent to that, when the person buys their property, meaning the person who hasn't paid taxes and that property is going to sale, they may get a loan. So you'll see the recorded mortgage on the title search. All the counties use a third party to do a title search report that tells them these are all the encumbrances and all the things that need to be resolved to try to transact the property at a tax deed sale. If the county, for whatever reason, doesn't name all those parties or thinks that one of those parties is dispensable and doesn't need to be named, it turns out they're wrong, then that interest survives. So case in point, we had a property that was in northern Florida. There were two mortgages, both with Wells Fargo. They named Wells Fargo and the servicer for the first mortgage, but not for the home equity line. That was not the second mortgage. It was like a $35,000 second, but that second wasn't named either by the recording of where the public record recording for the book and page and date of that mortgage. And they also had two different addresses. The primary mortgage was serviced by one company and the second was serviced by MERS, and they have different addresses, and that wasn't noticed on the county's lawsuit. So the first got foreclosed out, the second did not. So the investor doing their homework, and this guy was sharp, he said, look, it looks like the county didn't name this other mortgage. Do I have to worry about it? And the answer was yes. That would have added $35,000. They would have taken away $35,000 of his equity. And the reason is because that mortgage is recorded prior in time to his new deed. So yeah,
so he can't, I guess a quiet title in that instance doesn't wipe that out.
No.
So it's not a oops by the county, we'll deal with it in a quiet title. That was a really good catch on that investor's part that they caught that, because they would have inherited that mortgage and there's nothing you can do about it at that point.
Correct.
Interesting. I always attest to this industry. I learn something every day, and that is something I did not know about Florida and tax deeds. So that's critical for everybody out there. I know there's a lot of information out there that's saying that the tax deed auctions in Florida wipe out mortgages, and they should, but they don't in all cases. They have to be named, and if they don't or aren't, you did luckily inherit that mortgage. So anyway,
right.
Thanks, Michael.
And I'm not trying to infer that it happens frequently, but it does happen. The county attorneys are human. People make mistakes, especially when you're relying upon someone else's work product. If the county attorney is relying upon that third party's title search report for them to name all the parties they have to serve, if that examiner was asleep at the wheel and didn't name a party in their search report, the county attorney who reads that report may not look at it with their own fine tooth, like with magnifying glass, and say, wait a minute, we missed something. So they just perpetuate a mistake. And the one I referred to a little while ago about the incorrect legal description, that was also missed by the title examiner. So everyone missed it. So it does happen.
Interesting.
Yeah.
Interesting. Well, I think it kind of is a good segue, Michael, to my two favorite questions, or one favorite question and one I just like to know what's going on. But as far as pitfalls, risk aversion, whatever you want to call it, is there, like, if you were to give one piece of advice, that one big piece of advice in Florida for tax, lien or deed investors, both, what would be your one biggest piece of advice? Three
words: do your homework. Research, research, research. Forget location, location, location. This is all research, research, research. You're putting out real money. Real money is at risk. And if you don't do it right, you can lose your investment. Or your investment could be in something worthless.
Yeah, homework, due diligence. I think I hear that from almost everybody I interview, because this type of asset, whether it's tax deeds or tax liens, there's lots of little things like that nuance with mortgages we just talked about.
Right.
Excellent. And then my last question would be, as far as the process in Florida overall, are you aware of any changes coming down the pipeline that would be a great impact to the process as it is today?
No.
Everything's kind of pretty.
The biggest thing that changed was when Florida went digital for its online foreclosure sales and for online tax deed purchasing. It opened up Florida to the world.
Mm-hmm.
Now, who doesn't want to have a piece of land or a house on the beach in Florida they get for, pennies on the dollar? But unless you're doing your homework, you can make mistakes. You and I spoke yesterday about one of our clients who we're doing a quiet title action for, who bought a property in Palm Beach County in a very, very, very exclusive country club, got a good deal on it. It turns out that the house that he bought, he got a great price for it, but didn't realize that there's a mandatory non-waivable $80,000 assessment you have to pay to become part of the club, and the club is a mandatory membership. That added $80,000 to his cost. So by doing that, that took away $80,000 of equity. It took away $80,000 of cash he might otherwise have to invest in something else or in his bank or in his pocket. But he did homework, and he didn't look at a title search report to see if there's a recorded covenant for that homeowners association. Had he looked and bothered to call and say, hey, I'm looking at buying this property, anything special I need to know? The property manager would have said, if you buy this, you're going to have to pay this mandatory membership fee, so add it into your cost. So again, research is, it's so important that everyone understands to do the research or have someone qualified do it for them.
Exactly.
Yeah.
Well, I guess, Michael, any other gems of knowledge that you have that before we go?
Nothing specific I can think of. Let me just look at some notes real quick. I would say, aside from research, make sure you do the proper research for when your monies are due and how they're paid. We've had several clients that have done their research, they know what they want to spend on a property, and they didn't take the time to make sure that they knew the time frame under which the county required their deposits. And here they are logging on a Wednesday trying to buy a property, and it says you have no deposit on hand. That's because they sent their ACH 2 days ago, their automated clearinghouse payment. They lost out on potential good deals, and when they look back to see what the high bidder was, it was less than what they would have bid their maximum at. So they truly lost property just because they didn't pay attention to the fine details.
Lost time and money, right? At that point in time, all the research you did to figure out what you want to bid. So do your homework in, I guess, multiple ways, right? It's making sure you understand the logistics of attending the auction and understanding the properties and what underlying issues there might be on that property before you ever place a dollar.
Right. And one other really important thing, which is part of the research process that people don't always consider, is unless you're down the street or in the same county, or you can drive to the property you want to bid on, have someone else put eyes on it for you, whether it's using your services to have an inspector go out or finding someone on their own. Put eyes on the property so that you know it's still there. We had a client that bought a really nice house according to the pictures and Google Earth and the street map views, and the house was demolished like 15 days before the sale. Had they gone and sent someone or looked themselves, they would realize, wait a minute, the house is gone. I'm not going to bid on this. And they spent money thinking they have a structure there. So they lost out on opportunity and they lost out on money because now they got to either sell the lot or build something on it. They hadn't planned on doing that.
They probably inherited a demo lien at the same time, right? Yeah.
And the thing is that lien wasn't recorded, but when you went to the county's code violation site, it was shown, it was slated for demolition. So had someone just asked, and look, people aren't bidding on hundreds of properties at a time.
Mm-hmm.
You could be researching the whole month to bid on 10 properties, but it's hard dollars that you're putting out there. You need to protect it.
Interesting.
Just like we had a client that bought a property that burned to the ground in a fire. Had they had someone over there, they would have known. We had a client send an inspector to a property in northern Florida they're bidding on, and the police were there with a hazmat crew and someone was being taken out in a body bag.
Oh.
It turned out it was a great deal because we knew that the owner wasn't going to redeem, but they had to deal with hazmat issues. The person died in the house a month before the sale, and the family got involved saying, "Hey, where's grandma?" And someone knocked on the door and grandma had already started to decompose.
Oh, geez.
But no investor who was going to go, the investor went, and because they couldn't go themselves, they had someone go for them. And the inspector said, "Look at my phone. Look what's going on in the background. There's 3 police cars, there's a coroner, and there's persons being taken in a body bag. You should know this, that there's a problem." It turned out to be a great deal. They made a lot of money on the house, but they spent thousands of dollars with a hazmat crew to clean it up to make it safe to do work in.
These are the things that you never really come across in traditional real estate. You see not every day, but on a much more regular basis in the tax deed space.
Right.
Some of it fortunate, obviously some of it unfortunate. You certainly don't want those type of situations to happen. But anyhow, Michael, I sincerely appreciate you joining us today, educating myself as well as everyone else in attendance. Thanks everyone for watching. And Michael, we hope to have you back soon.
Pleasure. Thanks, Brian.